What's up, everybody? Redfin reports that real estate investors bought 26.1% of low-priced U.S. homes in the fourth quarter. That is the highest share on record and up from 24% the year before. By comparison, investors purchased 13.6% of mid-priced homes versus 14.3% a year earlier, and 15.9% of high-priced homes versus 15.4% a year earlier. If investors keep buying up all of the affordable housing, this could exacerbate the shortage of homes and drive up the costs for the everyday buyer. We are already facing an affordability crisis, and the impact of these investors could be significant. We all know that more inventory is needed in most of our country's real estate markets, and without it, home prices will remain high. So just how much of these lower priced homes are being gobbled up by these institutional investors? And where does that leave the future of our housing market? Ironically, or not, foreclosures were up in the fourth quarter of last year as well, and again in January of 2024. Does this mean that investors are grabbing up all of the discounted inventory? And if so, where does that leave the average American wanting to buy their first home? Is there any affordable housing left? So today, we'll take a look at an article by Lily Katz for Redfin titled, "Investors Bought 26% of the Country's Most Affordable Homes in the Fourth Quarter, the Highest Share on Record," as well as an article by the Adam team titled, "U.S. Foreclosure Activity Sees Notable Increase in January 2024. To see what they're saying. And as usual, I will chime in with my opinion as well. So let's dive right in. Redfin analyzed county home purchase records across 39 of the most populous U.S. metro areas to determine that investors bought more than 26% of low-priced U.S. homes in the fourth quarter. They define an investor as an institution or a business that purchases residential real estate. Redfin divides home purchases into three buckets: low-priced, mid-priced, and high-priced. Low-priced homes fall into the bottom third, mid-priced homes are in the middle, and the higher-priced homes are in the top third. It's not complicated to see why investors want the most affordable homes. They cost less and have more potential for profit. Whether by holding on to them and increasing their equity over the years, controlling the uptick in rents by monopolizing the competition, or fixing them up and flipping them. And foreclosures meet all requirements. They're usually sold at a discount, and if they are abandoned, there's usually room to do a quick fix and then resell. Adam, a leading curator of land, property, and real estate data, released its January 2024 U.S. foreclosure market report, which shows there was a total of 33,270 U.S. properties with foreclosure filings, default notices, scheduled auctions, or bank repossessions, up 5% from a year ago and up 10% from the previous month. We observed a slight uptick in foreclosure filings, which may be partially attributed to the typical post-holiday progression of filings through the legal system, said Rob Barber, CEO at Adam. However, other external factors may be at play, such as escalating interest rates, inflation, employment shifts, and other market dynamics. We remain vigilant in monitoring these trends to understand their full impact on foreclosure activity. According to Adam, the states with the highest foreclosure filings are Delaware, 1 in every 2,269 housing units, Nevada, 1 in every 2,272 housing units, Indiana, 1 in every 2,499, Maryland, 1 in every 2,588, and New Jersey, 1 in every 2,647 housing units. And the metros with a population greater than 200,000 with the highest foreclosure rates in January of 2024 were Spartanburg, South Carolina, 1 in every 1,579, Columbia, South Carolina, 1 in every 1,651, Cleveland, Ohio, 1 in every 1,742, Detroit, Michigan, 1 in every 1,799, and Las Vegas, Nevada, 1 in every 1,923 housing units. And with a population greater than 1 million, those with the worst foreclosure rates in January of 2024 were Riverside, California, 1 in every 1,944 housing units, and Indianapolis, Indiana, 1 in every 2,235 housing units. Ironically, Riverside, California is where investor purchases increased the most from a year earlier, up more than 25%, followed by Chicago, up 20.9%, and San Jose, California, up 18%. I don't think this is a coincidence. And if investment companies are buying up all of the affordable housing and then renting them out, they are taking away the possibility of individuals and families, especially first-time homebuyers, to purchase these homes, making an already low supply dip even lower. To make matters worse, these investors are mostly buying cash and accepting these properties as is. This makes them more appealing to sellers because there's no financing risk and no need to worry about appraisals, repairs, or updates. Because of their financial resources, institutional investors are often able to lose money on properties for a few years, eventually increasing rent enough to make it worthwhile, says Dennis Shurchikoff, head of content at Awning, a San Francisco-based real estate tech company and brokerage. It sounds like a sure thing for investors because they can manipulate the housing market to create more renters. With less inventory for would-be buyers to choose from, more people end up renting, which can then drive up rent prices. The top 5 states with the highest share of institutional investors, according to NAR, are Texas, 28%, Georgia, 19%, Oklahoma, 18%, Alabama, 18%, and Mississippi, 17%. The next 5 states, Florida, Missouri, North Carolina, Ohio, and Utah, all tied for 6th place with 16%. You would think with these higher home prices, investors would start to slow down, which they have done in certain areas. Redfin reports that the 5 markets that saw investor purchases fall by more than 60% are Las Vegas, down 67%, Phoenix, 66.7%, Nassau County, New York, down 63%, Atlanta, down 62.8%, and Charlotte, down 61.9%. Mind you, all home purchases in our country are down year over year. In Redfin's latest housing market update for the 4 weeks ending February 11th, pending home sales are down 7.3% year over year, one of the biggest declines in 4 months. And it doesn't help that interest rates have been going up again recently, with a daily average 30-year fixed mortgage rate at 7.09% on February 14th, up from 6.75% a week earlier and 6.54% a year earlier, according to Mortgage News Daily. This week's hotter than expected inflation report confirms that the Fed is unlikely to cut interest rates next month, which means mortgage rates will stay near 7% for now. Activity should pick up a bit in the spring, partly because it'll be selling season and partly because people are getting more and more accustomed to these elevated rates. We expect mortgage rates to start declining later in the spring as inflation eases and the Fed finally starts cutting interest rates, said Redfin economic research lead Chen Zhao. Other stats include an increase in the median sale price by 6.1% year over year, the largest increase since October of 2022. The metros with the biggest year-over-year median sale price increase are Newark, New Jersey, up 14%, New Brunswick, New Jersey, up 13.8%, and Miami, Florida, up 13.2%. The metros with the biggest year-over-year median home sale decrease are San Antonio, Texas, down 5.2%, Austin, Texas, down 1.4%, and Fort Worth, Texas, down 0.7%. New listings are up 8% year over year, while active listings are down 2.5% year over year. The metros with the biggest year-over-year increase in new listings are Dallas, Texas, up 28.6%, Jacksonville, Florida, up 28.4%, and Florida, up 26.7%. The metros with the biggest year-over-year decrease for new listings are Milwaukee, Wisconsin, down 13.5%, Atlanta, down 13.3%, and Chicago, down 11.9%. 35.3% of the homes still sold in the first 2 weeks, up from 34% a year ago. And 22.5% of the homes sold above their list price, up from 20% a year ago. And 5.6% of the homes for sale each week did have a price drop, up 1.1 points from a year ago. The bottom line is that with already limited inventory in most parts of our country, these institutional investors are simply making it worse for would-be buyers who want to own a home. They are gobbling up the most affordable homes, whether they are foreclosures or standard sales, and keeping rental prices higher by creating more renters. This is something we all should be watching as it directly affects home prices and, of course, rental prices. We need more affordable inventory for those who want the American dream of home ownership. If you missed last week's video on the industry insider's analysis of just how underbuilt our country really is, definitely check that out next. Thanks for watching. I do appreciate it. Bye!